But consumers have gone through their savings. They're racking up credit card debt. They're starting to default on that debt. Vacancies, people not paying their rent, people not paying their auto loans, they're all
Mhm.
ticking up. And in fact, foreclosures are now ticking up as well. Corporate bankruptcies. I mean, you have all of the things that happen in a recession. They're happening now, Michael. And so
Mhm.
I would not be surprised if this year is declared a recession.
I have to get something off my chest, but I have to ask if I'm right. We're gonna have this conversation real quick with Anna Kelly. How you doing, Anna?
I'm doing great. Great to be here.
I just have to get this off my chest because it feels like it's getting heavy. And that is the fact that I think 7% mortgage rates, 30-year fixed is a good thing. I hope we stay here, shoot, all year. I think the housing market is broken. I think rates going up and down like a chart is insane. I just want flat 7% all year. How's that hit? How do you feel?
I rarely disagree with you, but I don't like it.
Okay, tell me why.
Um, I think one, it is definitely going to drive down some prices because the demand just isn't there and the supply just isn't there. So it's going to be a very stagnant real estate market at
Yep.
7%, like we've already seen.
Mhm.
And I think for those that need to sell, it's really going to start driving down prices. Now, if you're a buyer looking to buy a home, that's good news for you. But if you're a seller, especially if it's your primary residence, which most homes are,
Mhm.
it's going to devalue equity and make people, frankly, have lower net worths than what they do today. Because most people's net worth, Michael, is actually tied up into the equity of their homes. And so, it is going to do kind of what we've talked about is already a problem, which is a widening wealth gap between the wealthy and the not wealthy. And so I just feel like when most people's wealth is tied up in their home, I
Mhm.
don't want to see a big correction of real estate values and see people get, poorer. And that's what keeping rates elevated for a long time does. Now, if we had not gone through a period of very low interest rates that lasted so long, but we
Mhm.
did, if we hadn't gone through that, in general, 7% is not crazy high historically. It's
Mhm.
about, I haven't looked at the average, but we've looked at rates all over. And I'd say probably in the 6% range, if I had to guess, would be like average
Yeah,
over
high
the
high
last.
sixes, high sixes, low sevens is actually average, depending if you go back 40 or 50 years. So yeah, we're
Yeah, I was gonna say
really close.
probably my lifetime. So, in
Mhm.
in in terms of historically, it's a good, healthy rate to be at. And quite frankly, I think because of all the things we've talked about on this show about me thinking that inflation globally is going to be higher, even if we have a recession and rates come down. I think that over the long term, we have a more inflationary world than we did, before 2 years ago. And
Mhm.
I think that the US Treasury rate is going to have to be higher because of our amount of US debt to entice people to buy treasuries. And the reality is the 10-year Treasury, the 30-year Treasury is really ballpark what the mortgage rates are based on. So I think that this is kind of around where we might be, other than a quick drop in interest rates and a recession and getting through that. On the other side of that, I think this is kind of where we're going to expect rates to be. But given the fact that we had such a period of low rates that drove up equity, I just don't like that. I know it's going to further
Yeah.
the wealth inequalities and reduce people's equity over time. So that's
Well,
the reason that I think I
let me
disagree with you.
let me play with that because again, I'm not calling for 7% rates forever. I'm calling
Sure.
7% rates for the year. And this is why. I believe a healthy housing market has more inventory. I believe a healthy housing market has higher days on market. I believe a healthy market has more inventory at all levels, entry, move up, luxury.
Yes.
And today, as we sit here at the end of February, can you believe it's the end of February? Where the heck is the
No,
year going?
I
Crazy,
know.
crazy. But the market's just not healthy. I want a healthy housing market. And now you're right. You're absolutely right. If you get caught in this window where you are a forced seller, it will hurt, no doubt. But as we're seeing already, the transactions are at rock bottom already, right? They're 3.8 to 4 million, maybe 4.1. So some
Mhm.
people undoubtedly be hurt. You and I both know the balance sheet, i.e. net worth, it's a fictitious number. It doesn't matter if you lose 5% this year if you're not a seller, it'll come back. I want to get to the other side and call the market healthy. I believe if we
Right.
go from 7.1, whatever it is today, to 6.5 again, it will get unhealthy. I was talking to real estate agents every day from about December 17th to about January 28th. And they were telling me multiple offers, over asking, waiving EMDs. I'm like, this is not healthy. I do not want to see 6.5. I think 6.5, Anna, feels better for folks that own in the moment, but it's a wreck 18 months later. That's my opinion.
The only thing to kind of push back on there a little bit is the issue is supply, but
Oh, no doubt.
supply is constrained because rates were so low. So nobody is going to sell now unless they're very motivated to sell for a reason.
Sure.
And keeping rates at 7% when you know that that impacts your ability of buyers to buy is
True.
not going to motivate supply to come back on the market and be a healthy market. The only way you're going to get not just homeowners who have to, if they wanted to sell today and give up their 2 to 4% interest rate mortgages, which I think 90% of
Mhm.
mortgages are in that range somewhere.
Yeah.
I think 80% are below 3 and 90% below 4, if I remember correctly. Nobody in their right mind, Michael, would sell today, give up that mortgage, pay a higher price for a property at a higher interest rate. Number one, they just can't afford to do it. Number two, they'd have to downsize to have a
Oh,
payment
yeah.
anywhere near that. So unless they have to move for death, divorce, or they absolutely have to move for the job market, which most
Mhm.
people don't have to move today to find good remote paying jobs, you're not going to get an increase in supply until that rate comes down enough, or till you have a huge housing correction and values fall significantly. So for me, staying at 7% is going to constrain supply even longer, and it's just going to break it longer. So I think you need rates to come down to get the supply there. Yes, initially you're going to have this like, thank God rates dropped. Now maybe I can afford a home. And you're going to have a demand that maybe dwarfs the even increased supply for a while. And
Mhm.
yes, that's going to be unhealthy. It's going to be hard for buyers, and there's going to be multiple bid situations in those markets that still are
Yeah.
considered undersupplied. In other markets where they're already starting to see correction in prices, I don't know that you're going to get quite as much of a multiple offer situation, especially as we tick closer to recession, which I've argued many times. I think we are. But I think that no matter where your rates go, you have this pent up demand. And so initially, when rates fall, yes, you're going to get that. But I think
Mhm.
we need lower rates in order for things to kind of stabilize,
Okay.
clear out the on the sidelines demand. And then you've got, as rates come down, enough sellers putting properties on the market that there's enough properties to spread those offers over, and you
Mm.
get some stabilization in price and supply and demand, in my opinion.
So I guess the $10,000 question for me to you is what's that magic rate that kind of unlocks supply? It's not 6.5. We've been there. That was just demand. What is the rate you
Yeah.
think?
I think probably 5.5, 5 to 5.5, because you're looking at mortgage payments,
Mhm.
and you're
Mhm.
looking at still high prices. So in order to bring down prices, which doesn't happen unless you have a bunch of supply, it just doesn't.
Mhm.
Unless you're in a market where there's just no supply or demand, and then people have to keep lowering the price to try to find somebody. But generally speaking, in the absence of prices falling significantly, I
Yeah.
think payments have to come down quite a bit. I was reading a chart the other day, and you and I have done this on some previous shows where we looked back over 50 years, and we
Mhm.
did, on, in terms of when you look at rents and you look at income and you look at payment, where the interest rates were, and you compare that to where, rents and then purchase price, mortgage rate payment as a percentage of your income. When you look back about 40 years, well, look back to actually 1985, and to buy a home, the average home price was 3.5 times your income.
Hmm.
Today, it's 6.6 times your income, the average home price. And so
Hmm.
you are double unaffordability when it comes to price per income. Now, that is not inflation adjusted. And so you and I have looked at numbers that are inflation adjusted, but to the perception of I need 6 times my income to buy an average home today. And then you look at the mortgage payment, it's a significant chunk of people's
Uh,
income.
I got to tell you, I hate that analysis.
I know you do, but
I
we've done
hate it.
we but the reality is, Michael, even though
Hmm.
there are different periods of time, like we've seen, and when we did the deep dives in these
Hmm.
spreadsheet, and I recommend viewers go back and listen to mine and Michael's videos when we talk about this. When you do the deep dive, you can see that as incomes go up, especially in certain areas,
Hmm.
even if rates and prices are what they do, depending on inflation at the time, you can see that, it goes up and down, but generally
Yeah.
speaking, we're not extremely unaffordable to the extent that some of your unfavorite,
Yeah.
unnamed sources on YouTube that say, the
The
sky is falling.
pretty chart boy. Pretty chart boy, we call him.
Right,
Pretty
right.
chart boy.
We're not maybe quite that, you know, due for such a major peak that there's going to be such a major correction. I wouldn't agree with him there. But for the average homeowner, Michael, all they're looking at is this is how much money I make. We
Well,
have inflation
it's the payment.
still.
It's I agree with you
It's the payment.
1000%.
Yeah, it's the
It's the
payment
payment.
compared to their income, while at the same time, even though inflation's coming down doesn't mean your prices have gone down. It just
Well,
means they're going up less
yeah.
this year than they did the last few years. So people are still saying, I'm living check to check. And you and I've talked about,
Oh
what
yeah.
was it? 80% of those surveyed say they live check to check, no matter their
Yeah.
income.
It's
So
terrible.
they just can't afford to move. And I think that payment difference has to be substantial for the average American to say, I'm going to give up my 2 to 3 to 4% mortgage
Oh, I agree.
and downsize. I think that you're going to have to be at the 5% mark. That's
Well,
just my opinion.
yeah, so let me just go back to that one statement that I said that I hate that analysis. And here's why. We've done this together, but just in case folks can't find the video. If you just look at income and price, like Pretty Chart Boy, you're missing interest rates.
Right.
I agree 1000% it's payment. If you are
Yes.
looking at income and price, that's not payment. And oh, by the way, if you look at income and price, 2021 would have been a horrible year to buy, like Pretty Chart Boy said. In reality, it was the second best year in 50 years to buy because you could get a mortgage rate below 3%.
Yes. And we
I
showed that.
hate, despise the simplicity of income and price because it is two of three variables. I
Right. And
agree.
you have to
It's
have all
payment.
three. You have to, because otherwise you're going to take the fear mongering, or you're going to think that it's a good time to buy when that comes down a little, even if interest rates are really high. So you've got to look at what's your monthly payment as a percentage of your
Exactly.
income. And that is right now at close to all-time highs. And so, I think rates have to come down to change that. And to get consumers who, by the
So,
way, consumer confidence is finally coming down, as we've been
yes.
talking about, we would
Yep.
expect. So as
Mhm.
consumer confidence comes down and you start to have layoffs and people are afraid to lose their job,
Yep.
there is no way on God's green earth that people are going to give up their mortgage to move. They're going to
Mhm.
go, we need to be
No.
content with what we have
Yep.
until rates come down significantly. And the good news for those that think, there's a few viewers who think I'm a doomer because I think there's a recession coming. But oh, by the way,
I don't think
the
so.
top CEOs of Goldman Sachs, JP Morgan, and
Oh yeah.
another big bank, but I can't remember which one right now, have all come out this week and said,
Hmm.
we're sorry, folks, but a recession is on the horizon. We are in
Yeah.
for a hard landing, and we were wrong about soft landing, and the lag effects are taking longer, but it's coming.
It's coming.
And
Yeah.
so the good news when a recession comes is that the Fed quickly lowers rates,
Yeah.
and they usually drastically. It's like a a slow escalator up. And then when
And
they
bam.
say, okay, it's bad enough, we've tackled inflation enough. Now we got to tackle the system and
Mhm.
save us out of a deep recession. It's like an elevator going down quickly. So rates will come
Yeah,
down. And I
yeah.
think that they will come down below 5, Michael. That's going to be kind of my call
Woo!
once a
In
recession is
2024?
declared.
This year? In
Well,
24?
when they declare the recession.
Okay, so that's
Um,
best case,
that
that's 6 months out, right? Best case.
well, I don't know. Most of the indicators are already, like we've
Okay,
talked about, 9 of 10 leading indicators are recessionary.
okay.
And some of the data continues to be revised downward later. It would
Mhm.
not surprise me. I won't make a huge bet on it, but it wouldn't surprise me if the NBER comes back and declares that we're already in a recession. They just
Yeah.
haven't done it yet.
Yeah, no
And
question.
so,
Okay.
it's the definition that they've used for recession has it's ambiguous enough
Oh, yeah.
that they don't necessarily have to do it with 2 negative quarters of GDP, for
True,
example.
true.
But we're, for all intents and purposes, whether it's called a recession or not, we are in recessionary conditions in 90% of the economy. We are.
Mm,
And so I could see it happening by the end of this year for sure.
okay,
I would guess not later than 2025. It's
okay.
really, really difficult to time. As all of you viewers know, as you and I know,
Yeah.
things have taken longer this time to have that like finally fall off a cliff because of just how much money has been in the system. But consumers have gone through their savings. They're racking up credit card debt. They're starting to default on that debt. Vacancies, people not paying their rent, people not paying their auto loans, they're all
Mhm.
ticking up. And in fact, foreclosures are now ticking up as well. Corporate bankruptcies. I mean, you have all of the things that happen in a recession. They're happening now, Michael. And so
Mhm.
I would not be surprised if this year is declared a recession. Um, it could be into 2025. We just don't know how long it's going to take for the
Yeah.
final nail in the coffin
Often.
to,
Right.
to break. And so I could see rates falling more than what some people say today. The caveat to that, and this is where, I keep saying, and I finally found somebody that agreed with me. I've been saying for 2 years, what I'm worried about is stagflation more
Mhm.
than a
You have.
recession.
Yeah.
I think inflation is stickier in many areas than many people think. And even though we're seeing improvements in inflation numbers, there's so many systemic global issues that are going to cause inflation to stay higher for longer. And that's going to cause rates to stay higher for longer until you have a recession. And the question is, what does the Fed do? It's really hard for the Fed, and I know this is probably getting a little too in the weeds, so I won't take too long to hit this point home. But when the Fed is just fighting inflation and inflation's coming down, it's easy for the Fed to say, we're going to keep rates high
Yep.
enough until inflation's at 2. And that's what the Fed has been talking and saying for 2 years, and Powell's stayed consistent on that. The issue is, how long can the economy handle rates that high? And we're starting to see it break in the commercial real estate world.
Mhm.
The banks are really starting to struggle. And Jamie
Mhm.
Dimon talked about that this
Oh,
week
yeah.
too, that there are more regional banks at risk of commercial real estate. That's the thing that worries him. He's
Yep.
okay, at Chase. But that's a real issue. And so the Fed now has to say, okay, when we get to the point that the rates are too high, that it really starts to break the banking system or that it causes a deep recession, we need to be able to go and quickly switch gears. But they can't cut rates, in my opinion, till they see that they have gotten inflation down enough. Because what happens is, if inflation stays, let's just say it stays at 3.2, I think is where it last was. Let's say it stays at 3, and we have a deep recession or a banking crisis, all of a sudden, they don't have the right tools to get that perfect soft landing where they can get enough GDP, enough employment, to get us out of recession, but also not have inflation continue to go up if they lower rates. Because when they lower rates, everyone that has money, this is where the haves and the have-nots get separated. Everyone
Mm.
that has money on the sidelines goes, let's go buy everything we can. We have a recession, let's go buy everything we can. Those that are just, homeowners or don't really know a lot about the economy, they're going to be frozen. But the wealthy are going to go spend real quick. That's going
Mhm.
to keep GDP and spending up a little bit. But that pushes inflation. And the issue is the Fed generally has two tools: rates and the monetary policy. Now there's
Mhm.
tightening money supply, they're tightening credit, and that usually can lead to recessionary conditions. But as soon as you start to lower those rates, if inflation ticks up at the same time, they're going to go, which one do we tackle? Which one do we tackle?
Right.
Because if we lower rates, inflation goes up. If we raise rates, recession gets deeper. So if we put too much money in the system, inflation goes up. If we pull too much money out of the system, recession comes. And so it is very, very difficult for central banks, the Federal Reserve in the United States, to balance and get you out of stagflation. If you look at history, it's
Mhm.
much easier when interest rates are normal and then we have a recession, no problem.
Right.
Quantitative easing, put money in the system, lower rates, we get you back in a year or 2, 3 years. If it's just inflation and the economy's booming, kind of like it has been until it doesn't, then they can say, okay, we'll keep higher rates until there's a banking issue and then we'll stop. But battling both at the same time, the Fed is not miracle workers and they don't
Mhm.
have a lot of tools. And so I think what we're going to have is a very quick recession. Only a recession or a banking crisis is going to force the Fed to lower rates. And once they do, I think inflation's going to raise its ugly head and the Fed is going to have to go back to, battling inflation. So I think we're going to have this kind of up and down, kind of stagnating economy for a while. And all I can say is the moment that we're in a recession and rates fall, every investor who has properties that are at higher interest rates needs to go refi and set your loans for as long as possible. You need to buy more properties when interest rates are low, even if prices are a little bit high. And then you wait. And then, when inflation starts to get worse again over time, you'll be happy that you have assets at really low interest rates. But I think, to bring it back to the beginning of this, over the long term, because of the debt, and we'll go into more debt, Michael, when
Mhm.
we're in a recession and the Fed
Oh,
has to
yeah.
spend money to get us out. So,
That's a proven. We know that's
you know,
coming.
so the reality is, the Fed has to kind of manipulate interest rates for its treasury auctions to get enough people that they can issue treasuries at an interest rate that they'll buy. I think 7% would not surprise me to kind of be the new normal once we're out of this whole
Kerfuffle. Yeah.
recessionary
Yep.
condition and the
Mhm.
Fed gets us back to some kind of stable economy. So I expect that that's going to be kind of more where we live in the longer term, but I think it's going to
Okay.
take us a few years to kind of get there. If everything else washes out and is stable and everybody can scoop up low interest rate stuff again before then 7% is not horrible. I just don't want to see it today. I think I just think it's going to hurt those who don't know how to really take advantage of um, finding really good creative ways to continue to do deals. The average
Mm.
homeowner is going to lose what little equity they think they have in their homes.
Anna, where can people find you?
You can find me here every week. You can find me at Anna Kelly Investing for real estate coaching, consulting, and deal review assistance. And you can find me on social media at Anna Kelly REI Mom.
Thank you so much.